Today, new conversations are essential in real estate, and they have to focus on a changing residential home market for buyers and sellers. For sellers, those conversations need to address the available homes for sale inventories and incentives for sellers to sell. Inventories have remained stubbornly low in California and Southern California. And with a history of regulations and law changes regarding capital gains and income taxes and rate hikes for mortgages, sellers today are almost de-incentivized to sell their homes. One big concern, and that is in addition to trading their refi and low current interest rate mortgages for a far less favorable higher interest rate loan, and fear of not finding a replacement home in a low inventory market is the burden of capital gains. And we have discussed this before. They seem to be increasing over time. And the question I've asked you before, Adam, is are there strategies sellers might consider to defer or reduce the capital gains taxes upon a sale of their personal home, or even a mindset? I mean, there's a lot of equity that has been realized in today's market. So capital gains may be reflective of those equity increases. Anyway, Adam, I turn the floor to you. Introduce yourself and your thoughts on how sellers may, jump back into the market. So it is very strong by seller's market, and the opportunities besides just having to sell, wanting to sell, trading up, trading down, what can a seller expect, and how might he deal with capital gains?
Sure. Thank you so much for the opportunity, Michael. It's been an honor to know you for such a long time. You've been extraordinary, and I know the value that you bring to your clients and your network is just really inspiring. I've been in the financial industry for about 14 years now. I actually wrote a book. It's an Amazon best-selling book. It's called Unleash Your Financial Powerhouse, which kind of look at the entire financial industry from a comprehensive perspective. And we really focus on the asset protection, the investment planning, financial planning, the tax mitigation strategies or preservation strategies, the exit planning, and then the legacy and succession. So real estate is a huge part of people's financial life, right? And wealth building strategies, right? And so there's two sides of it. One is the entry point and one is the exit point, right? How do we make sure that we create all of that with efficiency, with the ever-changing legal environment, with the ever-changing tax environment, the policy environment, right? And so capital gains come to play quite a bit when someone sells a property or any other appreciated asset, whether it's art or it's crypto or it's stock. And then, of course, there's elements of short-term capital gains or long-term capital gains. But what I think most of us are familiar with, and just for quick disclosure, right, I'm not a CPA or an attorney, right? Every client needs to speak to their advisors on the tax side and the legal side, even on the financial side. But the most familiar structure is exchanges, right? Where someone wants to sell a property, they have a certain level of appreciation. Without the exemption or barring the exemption, then they can save some money by exchanging it, identifying within 45 days and finishing the transaction within 180 days. But what people are less familiar with is structures like DSTs or Delaware Statutory Trust. They're less familiar with installment sales or installment notes. They're less familiar with monetized installment sales, or some of it there would be opportunity zones. And each one of those areas have pros and cons to any of it, right? And we can talk a little bit about some of those things. Some people may be familiar with something called PPLI, or private placement life insurance, which is another element of curbing some of the capital gains. But it depends on the size of the transaction and the size of the capital gain. So each one of those names, if you will, that I mentioned, has a lot to unpack. And I can give a little bit of depth, if you will, in addition to the names that I gave, and give maybe some of the appropriate times that someone can look at some of those things. But each one of those has pros and cons. And I mentioned no strategy is perfect.
Right.
There's always benefits, advantages, and disadvantages.
Good stuff. Very, very good stuff. I mean, there are probably also strategies for 1031 exchanges, but they cannot be your personal home. That's the issue. So the other things that you have talked about, and it's very interesting, other strategies, other way to grow wealth, is what you're talking about. And I think you've given sort of an overview. There are options. There are conversations with you, conversations with people who understand different the risk management and what's it called, deferring capital gains or maximizing the net equity in a transaction. And you are very, very good. I've known you a long time, Adam, and Amanda, your wife, and the whole RTB advisors and structures is really a phenomenal concept, and you do just terrific work. So you have a terrific book too. I've read the book, and I appreciate you coming on and talking about
absolutely.
A lot of thought.
Let me give you maybe a couple of things on alternative to exchanges, right? If we have a few minutes. So I mentioned DST, right? Most people think that if they didn't have property identified within 45 days, or if it's a market that is not favorable for them to find in a property, right, then they really don't have options or alternatives. So, and then they would stand, on the side, not selling the property, right, or not getting into a new property. And so the DST is something that allows people to exchange into structures that work similar to a syndication, but it allows them to take the capital gain and defer it into the future, right? Until they and they can do it over and over and over and over,
right.
Until they get a step-up in basis. But a lot of people do it temporarily just to mitigate the capital gain, and then they go and exchange it into another property, right? Which they can do with you. I know you're incredible at that. And so, but avoiding, if you will, a situation where maybe the market is changing, and because they didn't take advantage of the opportunity, they might have missed an opportunity to reduce the capital gain or defer it into the future. So DST is a great structure like that. And it's especially on investment properties, they can get a return for it. It's usually between 5 to 7, 8% tax efficient, meaning that they have depreciation with it. And then on the back end, they can also make the appreciation. And they usually, sometimes it's 2 years hold, sometimes it's 3, 4, 5 years. But and some of them has opportunities for refinancing or cashing out, at a certain time. So not all of them are created equal, but it's a structure that is considered to be an alternative to an exchange. Cool. The other thing I mentioned, go ahead.
No, I just wanted to know, just DSD, can you tell me what DSD stands for?
Yeah, it's Delaware Statutory Trust.
DST.
DST.
DST,
Correct.
Delaware
Yeah,
Statutory.
it's Delaware Statutory Trust, and it's just an alternative to an exchange. And people usually need to pick 3 properties, and oftentimes the third option that they pick is a DST, because if everything else falls through and the other 2 didn't get accepted, you can always get access to a DST. There's a lot of different projects out there, and namely by the big, some of them are household names like Cantor Fitzgerald and all of those big groups. And for someone that might be subjected to a big capital gain liability, if they place that into the placeholder as a contingency plan, then it avoids a situation where it falls through and now they have to pay the capital gain. That's one way of doing it. Yeah. The other thing, which is more recent in the last few years, is opportunity zones and opportunity zones funds. Now, it has advantages and disadvantages, right? The kind of like the big broad strokes, if you will, is that someone who has capital gains and they want to get a discount of 10% to get in of the current capital gain. And then anything that appreciates in the new project usually is going to be tax-free, capital gain tax-free for any new appreciation. Now, many of those groups also do a cash out option at usually after a year or 2. More likely after 2 years. And so let's say someone who had $1 million in capital gain tax liability, right? Now they can get a significant amount out and then buy the property with you, right? So they're not stuck in structures like that for a long time. But in the meantime, in order to mitigate or defer or eliminate a big portion of the capital gain, they have structures that they can use. And opportunity zones, in the big picture, what it is, they're they were proposed a few years ago in order to bring either commerce or jobs or investments into areas where they're underdeveloped or underserved. But surprisingly enough, there are so many different projects around the country, and some of them people would never even guess that they're opportunity zones, right? I mean, did you know that the Vegas Strip has some opportunity zone development there and projects? So some of those have extraordinary growth potential. The thing is, unlike investments or projects that are already existing and are already generating money or cash flow, right? This is something that typically takes a little bit of time, and they have to build it, they have to get the permit in, they have to get all of the things, and so usually the appreciation comes later. Right. So if someone just want to use it for mitigation of capital gains or getting discount of capital gain, they can use that types of structure, and then if they want liquidity. After a year or 2 years, then they need to look at projects that provides liquidity after a short amount of time, other than holding it. Traditionally, it's being held to minimum 7, but most likely 10 years. Those are the time horizons for opportunity zone. So,
terrific stuff. I mean, Adam, we've talked about this. I reach out to you when clients ask me, and I would unequivocally tell my clients or people watching this that they reach out to me, and more importantly, reach out to you, Adam, because there are tremendous investment opportunities and ways to defer percentages, as you've discussed, of these capital gains that actually will do good. The opportunity zones, at least that I'm aware of in Los Angeles, are quite interesting, and there are many of them. You like you said, there are many beyond what you are thinking. How this city wants to grow and incentivize investment of tax monies, deferred tax monies. And listen, Adam, I thank you so much for doing this, taking your time out of a busy day. This has just been interesting, informative material.
Yeah.
Much to ponder.
Yeah.
Any last words other than nice to see you? Glad you shared this again with me. I always need to check in with you and share this.
Yeah. No, absolutely. I would say the other thing I touched on it for a second was installment sales. And installment sales is essentially a structure where someone sells a property at an installment or receiving the funds at an installment. And therefore, they can defer the capital gain all the way up to 30 years. And so it's a really phenomenal structure that not as known, but there is a different element and different ways that it could be structured, that even though when someone waits to receive all of their funds, right, because the idea is to defer it as much as possible, because you get a discount on the capital gains, because future money is if you freeze it in time, is cheaper in the future, right? If you will, right? If you're, for example, if you have $1 million tax liability and you don't have to pay it all the way until the 30th year, right? $1 million then is maybe worth maybe $300,000, right? Or can buy $300,000. So there's advantages there. But there are structures out there that we're familiar with that actually provide liquidity, very high level of liquidity up front, based on that note of for the future, right? So if someone could get, let's say, 80% or 90% of the value of the property up front, and use that again to buy a property with you, or do whatever they want with that money. And then we create a structure that the liability or the tax liability will be paid in the future at the 30 years when the capital gain is come due, right? So there's different things like that, but it's pretty interesting. There's a lot of unique structures like that is highly valuable for the right people.
And that conversation on installment sale is a relatively newer conversation.
Yeah.
I mean, it beats to seller financing, because you can realize much of the profit in the equity, and then through this installment sale, lay off, defer those taxes. That's very interesting. Well, that's good stuff.
Yeah.
Anyway, Adam, I so appreciate it. That, by the way, the installment sale is something to really think about now.
Yeah. Yeah, and again, there's
part of my conversation, you need to call Adam, but this installment sale is a kind of a very interesting way, especially in a market like this. So,
yeah. And we do sessions with, of course, this typically is done in a team framework, right, with the attorney and the CPA and the and the facilitator, right? It's not just us, and it has to be the right situation for the client. And so we usually do an assessment. We have a discussion with the investor and see if it's the right fit for them. And if it is, we make all the connection, and we make sure that we speak to their CPA, their attorney.
Well, I know you take good care of the client, and you structure it right. You start, you set yourself up for success. Start right, and it'll end right. Anyway, thank you so much. What else can I say except thank you, and we'll talk again soon.
Yeah, looking forward to it.
Me too.